banks over 100 billion are now going to be subjected to what the rules of the GSIBs, the global systemically important banks, and that's where you include the AOCI marks into your tier one capital, and where you have this thing called TLAC, total loss absorbing capital, which, think of it simply as, for the GSIB banks, it's 20% of risk-weighted assets, 10% is equity, and 10% would be senior debt that would convert to equity in another crisis. So we wouldn't have to go through TARP. So the GSIBs have that 10 and 10 total loss absorbing capital of 20%. That's probably going to get rolled out to the 100 billion banks and above, where it has not been the case. So more pressure on banks, like in terms of probably slightly higher capital. And then the AOCI marks will burn off, but in the meantime, the equity will probably build a little bit. Share buybacks will come down a little bit. Dividend growth won't be as strong, and debt issuance will be a little bit picked up. So that's a little bit higher cost of capital or funding, if you will. They can roll off some Federal Home Loan Bank, so it's not going to be a total net headwind. But this is stuff that the bank managements are going to be dealing with in the next 2 years.
Okay.
But I think it'll be good for the system. You want an even playing field, and you want that safety and soundness, which we thought we had, and then we had March. So a lot of people were like now questioning, wait, are we that safe? Right? We were so focused on credit, and now we had this rate risk.